My business partner forged my signature on a $500,000 business loan. He took the cash and went on holiday. I called the bank manager immediately. He is no longer at the beach. Let me tell you what that phone call sounded like. It was a Tuesday morning in Nashville, Tennessee. I was at my kitchen table with coffee and my laptop, going through the monthly business account statement the way I went through it every first Tuesday of the month, because the first Tuesday of every month was the morning I reviewed the finances with the same systematic attention I brought to everything in the business. I had been doing this since we started the company 4 years ago. I had never missed a first Tuesday. The loan appeared as a debit entry dated the previous Friday. $500,000, drawn against the business line of credit. My name was on the loan documents. My signature was on the loan documents. I had not signed the loan documents. I had not been to the bank the previous Friday. I had not signed anything for the business the previous Friday. The previous Friday, I had been in Memphis for a client presentation that had started at 9 in the morning and had not concluded until 4:30 in the afternoon, and that 12 people had attended, and that 3 of them had sent follow-up emails afterward that were sitting in my inbox with the specific dated timestamps of people who expected a response. I had been in Memphis. My signature was at the bank. I sat at my kitchen table and I looked at the debit entry for exactly 45 seconds. I know it was 45 seconds because I was looking at the time on my laptop screen when I found the entry, and I was still looking at it when I picked up my phone, and I noted the time then too. Then I called Daniel Ackefer at Commerce First Bank. Daniel was the commercial banking manager who had managed our business account for 3 years. He was thorough, direct, and had the quality of someone who took the stewardship of his clients' financial relationships seriously in the way that good bankers took it seriously, which was the way you took something seriously when you understood that people's actual lives were built on top of the trust they were placing in the institution. He answered on the second ring. I said, "Daniel, this is Simone Clark. I need to talk to you about a loan transaction from last Friday." He said, "Ms. Clark, good morning. What's the transaction?" I said, $500,000 drawn against the business line of credit. My name is on the documents. I did not sign them. There was a pause. Then Daniel said, "Ms. Clark, let me pull the transaction." He pulled the transaction. He was quiet for a moment while he reviewed what was on his screen. He said, "Can you hold for 1 moment?" I said, "Yes." He was gone for 4 minutes. When he came back, his voice had a different quality, the professional calm of someone who was managing a significant situation and was doing it carefully. He said, "Ms. Clark, I need to ask you to come into the bank this morning. Bring whatever documentation you have establishing your location on Friday." I said, "I have 12 witnesses and a full inbox of follow-up emails from a client meeting in Memphis that ran from 9 a.m. to 4:30 p.m. He said, "Bring everything." I said, "Daniel, where is the money?" He said, "I can't discuss the specifics of the transaction until you come in and we complete the formal documentation. But I want you to know that the bank takes this type of situation very seriously, and we have processes for exactly this." I said, "I'll be there in 40 minutes. I was there in 35. Subscribe to this channel, hit that like button, ring that notification bell, and stay with me through the complete story. Because what happened between that Tuesday morning phone call and the moment my partner's beach holiday ended is the version of this story you need to hear in full. My name is Simone Clark, and I am 36 years old. I grew up in Nashville, Tennessee, in a neighborhood on the east side called Inglewood, where the houses were close together. And the community was real in the way that communities were real when people had been there long enough that the relationships between neighbors were built on actual history, rather than the proximity of matching real estate price points. My family had been in the same house since 1984, when my grandmother had purchased it, and where my mother had grown up, and where I had grown up after my mother, and I moved back following my parents' separation when I was 7. My grandmother, Dorothy Clark, was the formative figure of my professional thinking in a way I did not fully understand until I was an adult and could see clearly what she had been showing me. She had run a small bookkeeping and tax preparation service out of the front room of the Inglewood House for 22 years. Her clients were primarily small business owners in the East Nashville community, restaurant owners, contractors, retail shop owners, service businesses of every kind. She kept their books, prepared their taxes, helped them understand their financial position, and charged them fairly for work that was worth considerably more than what they could have afforded from a larger firm. She worked at a desk by the front window. I did my homework at the table behind her from the time I was 8 until I was in high school. I watched her work for 9 years without processing what I was watching as education, and then looked back on those 9 years from adulthood and understood that I had received an extraordinary education in small business financial management from someone who was both excellent at it and who did it with the specific dignity of someone who understood that the work mattered because the people it served depended on it. She died when I was 23. She left me the Inglewood House and her client list and a handwritten note that said, "The numbers tell the truth if you let them. Most of the problems people have with money come from not wanting to hear the truth the numbers are telling." I had kept the note. I had also eventually kept the client list. I went to Belmont University in Nashville on a partial academic scholarship and studied business with a concentration in accounting and finance. I worked 20 hours per week in the university's administrative offices to cover what the scholarship did not, and I finished in 4 years with a 4-point GPA and a sitting with the CPA examination scheduled for the month after graduation. I passed the CPA examination in August of the year I graduated. The 9 years that followed my graduation were the building years. I took over my grandmother's client base, grew it steadily, and transitioned from pure bookkeeping and tax work into the broader financial management advisory work that small business clients needed as they grew and their situations became more complex. By year 4, I had a client base of 31 active businesses, a staff of 2, and an office in a restored building in East Nashville's 5 Points neighborhood that I had leased specifically because it was close to the community my grandmother had served, and because the proximity mattered to me both professionally and personally. The business was doing well when I met Troy Merritt. Troy was 39 when we were introduced at a Nashville Chamber of Commerce networking event in 2020. He had been running a commercial real estate services company in Nashville for 7 years, property management, tenant representation, lease advisory work for small and mid-size commercial clients. He was organized, articulate, and had the specific social intelligence of someone who was good at professional relationship building in the way that commercial real estate required. We had 3 professional conversations before we had a conversation about whether our companies could do something together. The something together was a business services company that combined my financial management expertise with his commercial real estate and property management capabilities to serve the growing market of small business clients who needed both services and who were currently getting them from 2 separate providers who did not coordinate with each other. The integration was genuine. There were real synergies between the financial management work and the property side of a small business's operations, and combining them under one company with one client relationship created a better product than either service provided separately. The concept was right. I had done the financial modeling. The combined company made sense. We structured Clark Merritt Business Services as a 50-50 LLC in January of 2021. Equal ownership, equal management authority, defined responsibilities. I handled the financial advisory and accounting side. Troy handled the property and commercial real estate side, and we shared the client development and operations. Patricia Osai, my attorney who had been handling my business legal matters since my 3rd year of operation, had reviewed the operating agreement and had raised questions about several provisions. She had said that a 50-50 split was structurally clean but operationally challenging because tied decisions required a resolution mechanism, and the resolution mechanism we had drafted was the standard one rather than a customized one, and she wanted to make sure I understood the implications. I had said, "What do you recommend?" She had said, "A more detailed financial control provision. Specifically, any loan obligation above a defined threshold should require both signatures for execution, not just authorization, both signatures physically present at the bank." I had said, "How high should the threshold be?" She had said, "For a company your size, I would set it at $25,000. Anything above that requires both of you." The operating agreement we signed included that provision. Section 8, Paragraph 2. Any loan obligation or credit facility drawing above $25,000 requires the written authorization and physical signature of both members at the point of execution. Troy had signed the operating agreement. 4 years later, his signature appeared at the bottom of a $500,000 loan document beside mine. Mine was not mine. Daniel Ackerfer's office at Commerce First Bank had a window that looked onto the parking lot and a conference table with 4 chairs. He was seated when I arrived. Beside him was a woman named Joanna Reed, who introduced herself as the bank's fraud and financial crimes officer. Between them on the table was a folder that contained, I would find out, the physical loan documentation that had been presented and processed the previous Friday. I put my documentation on the table. The Memphis client meeting confirmation email from my client contact. The presentation file metadata showing the file had been opened and edited on my laptop from 9:15 to 4:50 on Friday. The follow-up emails from 12 attendees sent between 4:40 and 6:30 Friday evening. My fuel receipts from the drive to and from Memphis. The hotel receipt from Thursday night because I had driven down Thursday evening to be there for the 9 a.m. start. The hotel's checkout receipt showing a 9:04 a.m. departure on Friday morning. Joanna Reed looked at each document. She made notes. She looked at the folder in front of her. She said, "Ms. Clark, I want to show you something." She opened the folder. She showed me the loan documents. The documents were on Commerce First Bank letterhead with the standard commercial loan agreement format. The loan amount was $500,000 against the Clark Merritt Business Services line of credit, which had a limit of $600,000 and which had been established 2 years earlier to provide operating flexibility for the company. The interest rate was the current market rate. The repayment terms were standard. My signature was on page 4, beside Troy's signature. I looked at my signature for a long time. It was good. I want to be honest about that because the quality of the forgery was relevant to what followed. It had the right general shape. The letter forms were close. Someone had studied a legitimate signature of mine and had practiced the reproduction. But there were 2 things wrong. The first was the pressure pattern. My natural signature was produced with consistent light pressure throughout because I had been writing that signature for 36 years, and it had become automatic, and automatic signatures had consistent pressure. The signature on the document showed variable pressure, heavier in some strokes, lighter in others. The specific pattern of someone who was copying a shape they were concentrating on rather than producing from muscle memory. The second was the last letter of my last name. My lowercase e had a specific loop closure that I had been making since middle school when a teacher had commented on my handwriting, and I had started paying attention to it. The loop closure on the document's signature was not complete. It was left open in a way mine never was. I said, "This signature is wrong." Joanna Reed said, "Can you be specific?" I pointed to the pressure pattern and the loop closure. She made 2 additional notes. She said, "Ms. Clark, when you last accessed the business line of credit, what was the procedure?" I said, "Both Troy and I came to the bank together. We met with Daniel. We both signed the credit application. That was 2 years ago." She said, "Has there been any credit drawing on the line since establishment?" I said, 3 times. All 3 times both Troy and I were present and both of us signed. Daniel said, "That's consistent with our records." Joanna said, "Was Mr. Merritt present at the bank on Friday?" Daniel said, "I wasn't here Friday. I was at a conference in Knoxville. The transaction was processed by a teller." Joanna said, "What teller?" Daniel said, "Teller window 3, James. He called in sick this morning." There was a specific quality to the silence that followed that statement. Joanna said, "I'd like to speak with James." Daniel said, "I'll have HR make contact." Joanna turned back to me. She said, "Ms. Clark, I need to tell you what our process looks like from here." She said that the bank was initiating a formal fraud investigation. She said that the loan documentation would be held as evidence. She said that the funds drawn against the line of credit were subject to a hold pending the investigation's findings. She said that the bank's fraud investigation unit would coordinate with law enforcement if the evidence supported a criminal referral. I said, "Where are the funds?" She said, "I can't discuss the specific status of the funds while the investigation is active." I said, "Joanna, my partner forged my signature and drew $500,000. I know where he is. He told me on Friday that he was going to a beach house in Destin for a week with his family. He left Friday afternoon." She was quiet for a moment. She said, "Are you in contact with him?" I said, "He sent me a text Friday evening from Destin saying they had arrived and the weather was good." I showed her the text. She read it. She made a note. She said, "I'm going to step out and make a call. One moment." She was gone for 11 minutes. Daniel and I sat at the conference room table. He said, "Simone, I'm sorry this happened." I said, "I know." He said, "The bank should have had both parties present. The procedure should have flagged a single-party drawing." I said, "What happened with James?" He said, "I don't know yet, but I intend to find out." Joanna came back. She sat down. She said, "I've contacted our liaison at the Nashville field office of the FBI's Financial Crimes Unit. Given the amount involved and the interstate element, the transaction in Nashville, the subject currently in Florida, this is going to be a federal matter." I said, "Federal?" She said, "Wire fraud and bank fraud are federal offenses when the amounts exceed the threshold and when interstate activity is involved. $500,000 and a suspect currently in another state crosses both thresholds." I said, "How quickly does this move?" She said, "I can't speak to the specific timeline. What I can tell you is that the communication I just completed was taken seriously on the other end." She said, "Ms. Clark, is there anything else you can tell us about Mr. Merritt's situation? Financial pressures, unusual behavior, changes in the business relationship?" I said, "Yes, let me tell you about the past 8 months." The 8 months before the Tuesday morning had a pattern that I had been observing without nomming precisely, because I had not wanted the thing the pattern described to be what it appeared to be. Troy had been managing the property side of Clark Merritt with diminishing engagement since approximately the previous August. The client meetings he was responsible for had been attended with decreasing preparation quality. I knew this because I had been in 3 joint client meetings where his portion of the presentation had been noticeably thinner than it had been in earlier meetings, and where 2 clients had sent me follow-up questions about property matters that they should have been able to get answers to from Troy directly. 2 of our property management clients had mentioned to me, in conversations that were not specifically about Troy, that response times on maintenance requests had slowed and that the quarterly property reports had been arriving late. I had raised this with Troy in October. He had said he was restructuring his workflow and that it would improve. The improvement had been partial and temporary. November, he had asked me about a distribution from the company's operating reserves. He had framed it as a cash flow question. He had said he was short in a particular month and wanted to understand what the company's distribution policy was for situations like that. I had said the distribution policy was governed by the operating agreement and that off-cycle distributions required mutual consent and a written authorization. He had said he understood. He had not asked again. In December, I had noticed that the company's vendor payment schedule had 2 delays on invoices that should have been cleared in November. When I asked Troy about it, he said he had been managing cash flow conservatively and had delayed the payments while waiting for 2 client invoices to clear. I had reviewed the accounts. The client invoices had cleared in late October. The vendor payments had still not been made in early December. I had made the payments myself and noted the discrepancy in the financial records without saying more to Troy at that point. In January, I had received a call from a commercial landlord who managed 3 of the properties in our property management portfolio. He had said that the communication from our firm had become inconsistent and that he was evaluating whether to move the management of those properties to another firm. I had spent 45 minutes on the phone with him restoring the relationship and then had a difficult conversation with Troy about the call. He had said he was dealing with some personal situations and that he would get the communication back on track. In February, I had seen a LinkedIn notification that Troy had viewed the profiles of 2 competitors, both firms that handled commercial real estate and property management services in Nashville. The notification was automatic, and he had probably not realized it would appear in my feed. I had noted it without mentioning it. In March, I had had a conversation with Patricia that I want to describe specifically, because it was the most important single conversation in the 8 months before the loan. I had called Patricia and told her I was observing a pattern of behavior from my partner that concerned me. I described each of the incidents above. She listened without interrupting. When I finished, she said, "What's your read on what's happening?" I said, "I think he may be considering an exit. Either he's preparing to start something new or he's in some kind of financial difficulty and managing it in ways he's not being transparent about." She said, "What do you want to protect?" I said, "The company's financial integrity, the client relationships, my personal liability for anything that happens on his side." She said, "Let's review the operating agreement." We reviewed it. She said, "Section 8 is still in the agreement, the dual signature requirement for any obligation above $25,000. I said, "Yes." She said, "Has he violated it?" I said, "Not that I know of." She said, "I want to make sure you have a complete picture of the company's credit and debt obligations. Go to the bank and request a full account status report that includes all outstanding credit facilities and any activity on the line of credit in the past 12 months. I said, "Why?" She said, "Because if someone is planning something, the financial instruments are where it shows up first." I said, "Patricia, do you think he would?" She said, "I don't know what he would do. I know that the pattern you're describing is consistent with someone who is in financial difficulty and who is managing it through opacity rather than transparency. I want you to have a complete picture before anything happens." I had called Daniel Acaffer the following week and asked for the account status report. Daniel had sent it. The report showed no unusual activity on the line of credit as of that date. The balance was 0. All 3 prior drawings had been repaid. The line was clean. I had filed the report and exhaled. 3 weeks later, Troy took $500,000. I thought about Patricia's call every day for the following week. She had said the financial instruments were where it showed up first. She had been right about the first part and right about the timeline and right about everything except whether 3 weeks was enough time. I told all of this to Joanna Reed. She listened and made notes on a legal pad that filled 2 pages. When I finished, she said, "Ms. Clark, do you know if Mr. Merritt has other financial obligations that may have motivated this action?" I said, "I know he mentioned personal financial pressure in January in the context of a conversation about company distributions. I don't have specific knowledge of his obligations." She said, "That's useful context." She said, "I want to be clear with you about something. The bank's liability in this situation is a matter that will be assessed as part of the investigation. The question of whether the bank should have required both parties to be present for a drawing of this size is a legitimate question, and the bank takes it seriously. I'm not in a position to make commitments about how that question will be resolved, but I want you to know it's part of what we're looking at." I said, "I understand." She said, "Patricia Osai is your attorney?" I said, "Yes." She said, "I would recommend having her involved in everything from this point forward." I said, "She already knows. I texted her from the parking lot." Joanna almost smiled. She said, "Good. I left the bank at 11:47. Patricia called me at noon. She said, "Tell me everything." I told her everything. She said, "The FBI involvement is significant. The bank called them directly." I said, "Their fraud officer made the call this morning." She said, "The combination of the bank's internal fraud investigation, the FBI financial crimes referral, and the civil claims we're going to file creates a very complete set of pressure from multiple directions." I said, "Civil claims against what? He spent the money." She said, "Civil claims against him personally, against any assets he holds, and against his professional licenses. Commercial real estate brokerage licenses in Tennessee are issued by the Tennessee Real Estate Commission. A criminal fraud conviction results in automatic license revocation, but the license can also be suspended pending criminal charges." I said, "His entire professional operation depends on his license." She said, "Yes. Filing the civil claim and notifying the commission of the pending fraud matter suspends his ability to transact business while the matter is unresolved." I said, "You can do that today." She said, "I can file the civil claim today. The commission notification follows the filing." I said, "Do it." She said, "There's one more thing." I said, "What?" She said, "The vacation, the beach house in Destin. If he used any of the loan proceeds to fund a vacation, that's a specific additional element of the fraud. The prosecution of the main charges is not affected by that, but the optics of someone who forged a business partner's signature and then went on holiday with the proceeds they are useful in certain ways." I said, "His family is with him, his wife, his 2 kids." She said, "That's a harder situation. The criminal process is focused on him." I said, "I know." She said, "How are you doing?" I said, "I'm functioning." She said, "That's enough for right now." She filed the civil claim at 3:45 that afternoon. The Tennessee Real Estate Commission notification went out at 4:10. Troy was in Destin for 4 days before he came home. He did not come home voluntarily in the sense of having decided his holiday was complete. He came home in the specific sense of a person who had received communications from multiple directions that made remaining on holiday unsustainable. The first communication was from Patricia's office, which had contacted his personal attorney, a man named Warren Collins who had handled Troy's personal legal matters since before Clark Merritt with the civil claim documentation. Warren had called Troy on Tuesday evening. The second communication was from the Tennessee Real Estate Commission, which had sent him a notice regarding the pending fraud matter and the associated suspension of his license pending investigation. That notice arrived by certified mail to his Nashville address and was also sent to his email on file with the commission. The third communication was from the FBI. I do not know the specific form of that contact because I was not party to it. What I know is that by Wednesday morning, Troy's personal attorney, Warren Collins, had called Patricia Osai and said his client was returning to Nashville and was prepared to speak with investigators. Troy landed in Nashville on Wednesday afternoon. I know this because Patricia told me. I know it because, in a separate and more personal sense, his wife had texted me. Her name was Angela, and I had known her for 4 years through the professional relationship with Troy that had occasionally included social occasions. She was not involved in the fraud. She had been on a family vacation that she believed was being paid for through Troy's normal earnings. When the situation had become clear to her through Troy's responses to Wednesday's communications, she had called him on his behavior in terms that had apparently been heard through the walls of the beach house, and that had produced a decision to return to Nashville that was mutual rather than unilateral. She texted me Wednesday evening. She said, "Simone, I need you to know I had no knowledge of what he did. I am horrified. I am so sorry. I understand if you don't want to respond to this. I just needed to say it." I looked at that text for a long time. Then I wrote back, "I believe you, Angela. This is not about you." She wrote, "Thank you." That was the full exchange. Troy met with the FBI financial crimes investigators on Thursday morning. Warren Collins was present. I was not present. Patricia was in contact with the investigator's office throughout the day. The interview produced the account of what had happened that I will describe now based on what came out in the legal proceedings. Troy had been carrying personal debt for approximately 18 months that had accumulated through a real estate investment he had made independently, separate from Clark Merritt, using personal capital that had gone badly in the rising interest rate environment of the previous 2 years. The debt had been managed initially through personal credit facilities, and then through a private loan from a family member, and then through arrangements that had become increasingly strained as the debt's carrying costs exceeded what his personal income could manage while maintaining the lifestyle his family was accustomed to. He had developed the forgery plan over approximately 6 weeks before executing it. He had studied my signature from legitimate documents that he had access to through the normal operation of the business. He had practiced the signature. He had identified a Friday when I would be out of the city for a client meeting, and when Daniel, who knew both of us personally, would also be absent. He had gone to the bank on Friday morning, dressed professionally, and had presented a loan authorization package that included the forged signatures and the business documentation he had access to through the company's files. James, the teller, had processed the transaction. The investigation into James's role was a separate matter that I was not involved in, but that Joanna Reed told me was being addressed internally and with appropriate seriousness. The $500,000 had been wired to a personal account Troy had opened at a separate institution 3 weeks before the transaction. From that account, approximately $60,000 had been dispersed in the 4 days between the transaction and his return from Destin, some toward the family vacation, some toward the private loan obligation he had been carrying, and some toward other personal expenditures. $440,000 remained in the receiving account when the investigators placed a hold on it on Wednesday morning. Patricia said when she told me about the recovered funds, "The bank's fraud hold and the FBI freeze working simultaneously is why the money was still there. He didn't have time to move it before everything landed at once." I said, 4 days. She said, "He got 4 days of a beach vacation out of it." I said, "That's the specific detail that will be in every piece of litigation about this." She said, "Yes, it will not help him." It did not help him. The criminal charges were filed by the United States Attorney's Office for the Middle District of Tennessee. Bank fraud under 18 U.S.C. 1344, wire fraud under 18 U.S.C. 1343, and aggravated identity theft under 18 U.S.C. 1028A for the use of my forged signature in the commission of the fraud. The charges carried potential sentences that Warren Collins communicated to Troy with apparent clarity, because the plea negotiation process began significantly faster than such processes typically began. The bank's civil liability to me was addressed through a separate negotiation that Patricia conducted with the bank's legal department over 6 weeks. The bank acknowledged that the transaction should not have been processed without both account holders present, particularly given the loan amount and the dual signature provision in the company's operating agreement that was on file with the bank. The bank's settlement covered the difference between what had been recovered from Troy's account and the original loan amount, made the company whole on the $500,000, and included an acknowledgement of the procedural failure. Daniel Acaffer was not involved in the bank's procedural failure. He had been in Knoxville. He called me the week after the initial bank meeting and said he was sorry and that in 15 years of commercial banking, he had never had a client's account compromised in this way, and that it would not happen again under his watch. I believed him. Clark Merritt Business Services dissolved as a legal entity 6 months after the loan. Not because the company was financially destroyed. The combination of the recovered funds and the bank settlement had made the company financially whole. The company dissolved because operating a 50-50 partnership, when one of the 50% was facing federal fraud charges and had his professional license suspended, was not operationally viable. and because dissolving the partnership cleanly was better for both the clients and the employees than maintaining the structure while its foundation was absent. Patricia managed the dissolution with the organized efficiency she brought to everything. The operating agreement's dissolution provisions were specific, and she executed them specifically. The company's assets were divided per the agreement. The client list, which was the company's most significant asset, was divided between me and Troy per a negotiated protocol that gave clients the choice of which firm to follow, and that produced, in the event, a client retention rate of approximately 80% on my side and approximately 20% on his side, which was a distribution that reflected something accurate about what clients understood about the relationship they had been paying for. The employees we had 4 at the time were offered positions with my reconstituted practice. 3 accepted. The 4th, who had worked primarily on the property management side, went with the clients who followed Troy's portion of the work. My firm, back to Clark Financial Advisory after the dissolution, reopened on the same day Clark Merritt's doors formally closed, in the same East Nashville office, with the same 3 employees and 26 of the 32 clients. The first thing I did on the day the new firm opened was call Daniel Ackheffer and establish the new business account with the dual signature requirement formally documented as a structural requirement for all credit facilities and loan obligations, regardless of amount. Daniel said, "That's already my recommendation for all of my small business clients going forward." I said, "Good." The second thing I did was update my grandmother's client management system. I still used a version of the approach she had used, adapted to current technology, but following the same organizational logic, to reflect the reconstituted client list and the new firm's operational parameters. The third thing I did was call Patricia. She said, "How does it feel?" I said, "Like the right size." She said, "The right size for what?" I said, "For what I'm actually running, which is my practice, what I built, not a combination of my practice and someone else's professional problems." She said, "Your grandmother would be pleased." I said, "She would have seen it coming before I did." Patricia said, "Possibly. She also would have seen Troy coming before you did." I said, "Patricia." She said, "I'm just being accurate." I said, "Fair." She said, "You saw something in February. You called me. We reviewed the agreement." I said, 3 weeks earlier would have been better." She said, "Yes, but you had the dual signature provision, which is why $440,000 of the $500,000 was still in the account when the freeze went through. The provision was there because you built it in at the beginning." I said, "You built it in." She said, "You said yes when I recommended it. Plenty of clients don't." I said, "Why not?" She said, "Because it feels like distrust, like you're setting up the partnership to fail before it starts." I said, "It's not distrust, it's structure." She said, "Your grandmother would have said that." I said, "She would have." She said, "She did, actually, to me, twice, in different conversations, about different clients. The specific sentence was, 'Protection is not the absence of trust. It is the structure that makes trust possible.'" I sat with that for a moment. I said, "She said that to you?" She said, "At the $48 per hour rate I charged her in 1999, when I had been practicing for 3 years, and she was one of my first clients. She was not wrong." I said, "No." The plea agreement in Troy's federal case came through 8 months after the charges. He pleaded guilty to 1 count of bank fraud and 1 count of wire fraud. The identity theft charge was dropped as part of the negotiation. The sentence was 27 months in federal custody, 2 years of supervised release, restitution of $60,000 representing the funds that had been dispersed before the freeze, and permanent revocation of his Tennessee real estate license. The restitution was $60,000 because the bank settlement had covered the remainder of the $500,000, and I was not a party to the restitution calculation, except as the victim whose documentation had made the criminal case possible. Patricia attended the sentencing hearing. I did not. Not because I was indifferent to the outcome, because I had said everything I needed to say in the victim impact statement that Patricia had helped me prepare, and that was submitted to the court in writing. The statement was not dramatic. It described the impact of the fraud on the business, on the clients, on the employees, and on the professional trust that my business depended on, and that the fraud had required me to rebuild from a position it should never have been in. It ended with one sentence that my grandmother's note had given me. The numbers tell the truth if you let them. The Monday morning account review had let them. East Nashville in the spring was the version of the neighborhood I loved most, which was the one where the trees on the residential blocks behind 5 Points were fully green, and the morning light on the storefronts was the specific warm quality that made the neighborhood look exactly like what it was, a place that had been through many versions of itself and had arrived at the current one with the particular energy of a community that was genuinely alive. I walked to the office from the parking structure on Monday mornings when the weather allowed it, which was most Mondays in spring. The walk took 11 minutes and passed 3 of my current clients' businesses: a restaurant owner who had been with me since my grandmother's client list, a contractor whose accounts I had been managing for 6 years, and a retail shop that had started as a client of my grandmother's and whose current owner was the same woman who had been there when I was 8 years old doing homework at the table behind my grandmother's desk. She waved when I walked past. I waved back. The office had 12 clients' files on the active roster that morning, not the 32 I had brought into the dissolution, but 12 new client relationships that had come through the referral network of the 26 who had followed me from Clark Merritt. The new clients were newer relationships, less established, still in the phase of a client relationship where you were proving to each other what the relationship was. That was fine. That was where real client relationships started. Patricia had sent me a note the previous week about a new LLC formation client. She was referring to me. She said the client was a woman starting a home renovation business and that she needed a financial management advisor who understood small business from the inside and who would be direct with her about what the numbers were saying. I had said I would take the call. The new client called on Thursday. She was 28 and had been renovating homes on the side for 3 years while working a full-time job and had decided the side work was the real work and was ready to make it the official work. She was organized, clear about what she understood and what she did not, and asked good questions. Near the end of the call, she asked about business partnerships. She said she had a friend who was interested in co-founding the company, and she was thinking about what the structure should look like. I said, "Tell me about the friend." She told me about the friend. I said, "When you write the operating agreement, include a dual signature requirement for any debt obligation above a threshold you are both comfortable with." She said, "Why?" I said, "Because structure is not the absence of trust. It is what makes trust possible." She said, "Where did that come from?" I said, "My grandmother, through my attorney. Both of them knew what they were talking about." She said, "I'll remember that." I said, "Write it down." If this story meant something to you today, hit that like button, leave a comment, share it with anyone who is about to sign a partnership agreement without a dual signature provision. Subscribe to this channel and ring the notification bell. Every story here is this complete. Write it down before you need it. Take care of yourselves. See you next time.